What I mean by that is as follows. Let's talk about that accrued but unused sick pay that many people get after they leave service, which can result in a rather sizable check. Well, they get this check or they're about to get the check in cash, but they know, they have heard that their aunt's cousin's mother's sister's son just became a financial advisor, and he heard about this 5-year provision just before he fell asleep one night. So what happens is, when they hear about this, they go into the Human Resources Office from the organization from which they're leaving service or retiring, and they say, look, we give away our right to receive these amounts in cash. We'd like you to take advantage of this unique 5-year provision. Deem these amounts to be an employee or contribution, because we know employee or contributions don't show up in box 1 of your W-2, nor are they subject to the FICA taxes, whereas of course amounts subject to a salary reduction are, where FICA is applicable to the organization, of course subject to the FICA taxes. So it's a very, very important benefit. What that individual did by giving up the right to receive that in cash was make a cash or deferred election. In other words, an elective deferral. And hey, they're not in the 5-year provision. They're back under the regular elective deferral rules. So it's important to note that while a lot of money could be put into the 403B, based upon 2007 monetary standards up to $225,000, it's important to note that this cannot in any way, shape, or form be done by a direct or indirect cash or deferred election. It must be the employer's own money. Well, what happens then is that in writing this up, sometimes individuals can get even more than $225,000 if they, instead of specifying a dollar amount for each of those 5 years after leaving service, they went ahead and they said up to the maximum legal limit, because we know that this overall limit is subject to indexing each year. And for 2007, it's $45,000, but maybe more potentially in 2008, 9, 10, 11, 12, etc. So sometimes what happens is you have a union. By collectively bargained agreement, individuals have the right to receive in cash accrued but unused sick pay. The union goes in the due course of collectively bargained renewals, or as a memorandum of understanding, an amendment to their pre-existing collectively bargained agreement. They go in and they give away the right to receive this cash on behalf of all employees for the duration of the collectively bargained agreement. And then, since these employees do not have that right, they ask that amounts pursuant to a formula that represented accrued but unused sick pay be contributed to a tax sheltered annuity under 403B. Now that would work, that would be okay. But what happens is, since this is a 5-year payout, many members are worried that if they should pass away during those 5 years, they want the remainder of any funds paid to their beneficiary, or they would like contributions continued to their 403B on their beneficiary's behalf in regard to the remaining period of time. Well, the regulations have some great examples of this, and one of them show us that there really can't be contributions after the individual dies. And of course, as we know, since these are non-elective contributions, there is really no remainder of funds to be paid to a beneficiary. So this is an extremely good benefit of 403B, and I would ask that anyone organization who is interested in offering this to their participants look specifically at the text of the regulation and the examples, because for organizations that are non-government, there are issues to assure that these contributions do not discriminate in favor of highly compensated participants as against non-highly compensated participants. So there are good examples. Please check them. And as I was saying, when you were using this in a non-governmental environment, again, there are non-discrimination rules, so it's very important that in accordance, as I said, with certain non-discrimination rules to assure we don't favor the highly compensated, one would have to test under a regulation under 401A4 of the Internal Revenue Code, known as 1.401A4-10B. This, of course, is set out in the regulation, and it would assure that highly compensated were not favored as against non-highly compensated in structuring this type of a program. However, if you're in a governmental environment, you're not subject to non-elective non-discrimination and therefore would not have this additional concern.
Bob, so there can be no hint of a cash or deferred arrangement?
That's absolutely true. When using this 5-year provision, there must be no hint of a cash or deferred arrangement. And that is to say, these must, and I can't emphasize that enough, Denise, these must be non-elective employee-or contributions. They cannot be an employee's cash or deferred salary reduction type contribution for this 5-year provision. It's very important for folks to understand and not get confused or cross wires in regard to what we discussed earlier. That is to say, the after-service or post-retirement elective deferral opportunities, that rule for the later of that taxable year or 2.5 months, they cannot get that confused with this 5-year provision, which doesn't deal with elective deferrals whatsoever. So you're right, there can be no hint of a cash or deferred election in attempting to take advantage of the unique 5-year provision for 403B.
Are these regulations bringing 403B plans closer to 401K plans?
Well, absolutely, because of the fact that for elective deferrals to 403B, they have to be limited to contributions under a cash or deferred election as defined under 401K. So to determine if we actually have the cash or deferred election in 403B, we turn to its greater cousin, 401K, to see how the rules actually work. In addition, if, for example, our 403B program offered individuals the right to receive funds on account of financial hardship, we know that a 403B program can offer this opportunity for people who encounter financial hardship, but only limited in dollars to the elective deferrals they put in, not considering earnings. Now, if they, for example, were to take some of these hardships, the issue is, do individuals really have a hardship? And for determining that, 401K, which offers the same type of distributable opportunity for those who encounter financial hardship, has varying safe harbors. That is to say, actions that can be taken in regard to an individual securing their funds for certain enumerated safe events that are set out in 401K. These safe harbors can be used with equal force and effect in validating the validity of a distribution for 403B on account of financial hardship. So in these instances, these are excellent examples of 403B being brought closer to 401K.